Given our today's situation, this pandemic results in a high rate of unemployment, and it gives impact to those unemployed individuals to their standard of living, whereas it affects their physical and mental health. Because, for instance, they are problematic of how to buy goods as loss of income is present. Besides, in families, they prioritize their children's health, but how do they focus on it if they lack in money? Because of unemployment, its impact in society includes higher rate of crime. Regarding governmental costs, unemployment leads on giving assistance for the families using the country's tax. Second major pure risk is property risk. This is defined as the property damage or loss because of fire, tornado, earthquake, windstorm, lightning storm, and other numerous causes. There are two major types of loss in property: direct and indirect loss. Direct loss is simply defined as financial loss resulting physical damage, destruction, or theft of the property. For example, there was a fire and your home is caught by it. So, this is an example of direct loss. On the other hand, indirect loss is the financial loss resulting indirectly from the occurrence of a direct physical damage, destruction, or theft loss. Let's go back on our example. Your house was damaged by fire, and because of that, you may incur additional expenses to maintain your normal standard of living. You may rent an apartment while your home is being repaired. You may have to eat at local restaurants and buy ukay-ukay clothes. And this is called indirect loss. The third major pure risk is called liability risk. This is someone is legally liable if he do something that results in bodily injury or property damage to someone else. In terms of professionalism, someone can be sued by patients or clients because of the alleged acts of malpractice. Suppose you are playing baseball with your friends, but you accidentally hit the ball backward and your neighbor's door got damaged. Accident or not, you are still liable and need to settle for the broken property. Another example is you are a doctor and you conduct a DNA test. However, your client discovered that the papers were fake and you were bright. By that, you are legally liable because of your profession's malpractice. Regarding in this risk, there are several reasons that are important, such as there is no maximum upper limit with respect to the amount of loss. A lien can be placed on your income and financial assets to satisfy a legal judgment. Legal defense costs can be enormous. Suppose you own a car that costs 500,000. Therefore, the maximum physical damage is 500,000. However, let's say you caused a car crash and the other driver was in serious bodily injury, meaning you can be sued for any amount by the person you have injured. So, assuming that the court of law orders you to pay damages to the injured party, however, you cannot pay them, so your income and financial assets will be linked to satisfy the judgment. Liable in the injured party as it is their fault, but they keep pushing that you're involved. So, you will cost of hiring an attorney to defend you, adding the other cost for investigations, producing of papers, attorney fees, and other legal expenses that can be staggering. Another important type of pure risk is commercial risk. As business firms face a variety of pure risk, it can financially incapacitate firms and loss occurs that will lead to bankruptcy. And this risk includes property risk, liability risk, and loss of business income. Property risk involves business properties such as buildings, furniture, equipment, supplies, company cars, inventories of raw materials and finished products, accounts receivable records, and other valuable business records that are damaged or destroyed and expensive to replace. Liability risk involves bodily injury and property damage that can be sued according to some common reasons such as defective products, pollution of the environment, damage of property, injuries to customers, violation of copyrights, discrimination against employees, and sexual harassment. Aside from this, directors and officers may be sued by stockholders and other parties because of financial losses and mismanagement of the company. In terms of loss of business income, it may be shut down for several months because of physical damage lost to business property because of fire, tornado, hurricane, earthquake, or other perils. During the shutdown period, the firm will lose business income, which includes loss of profit and local markets. In addition, certain expenses may continue, such as rent, utilities, leases, interest, taxes, some salaries, insurance premiums, and other overhead costs. Finally, as the firm restores, extra expenses may incur. For example, the cost of relocating temporarily another location, increased rent, and rental of substitute equipments. Because business goes up with a wide variety of additional risks, some are summarized here. In crime exposures, this includes robbery and burglary, shoplifting, dishonesty and fraud, internet-related crimes, theft of intellectual property, computer crimes, embezzlement, and employee theft. Concerning human resource exposure, it includes job-related injuries, disease of workers, and death or disability of key employees and retirement plans. In the matter of foreign loss exposures, it contains acts of terrorism, damage to foreign plants and property in business, political risks, kidnapping of key personnel, and foreign currency risks. In connection with the intangible property exposures, it covers the damage to the market reputation and public image of the company, the loss of goodwill, and loss of intellectual property. As to government exposures, it involves laws and regulations that have significant impact on the company, namely laws increasing safety standard, laws requiring reduction in plant emissions and contaminations, and new laws protecting environment that increase the cost of doing business. Now, let us jump to major burden of risk on society. The presence of risk results in undesirable social and economic effects. This risk entails three major burdens on society. First, about large emergency fund. Business firms increase the size of the emergency fund to pay for unexpected losses. Suppose you buy a home that cost 500,000 and you want to accumulate a fund for repairs if it will be damaged by perils. Without a fund, you need to save at least 50,000 annually. However, an early loss can occur while your emergency fund may be insufficient to pay for the loss. In any event, the higher the amount that must be saved, the more current consumption spending must be reduced, which results in a lower standard of living. The second burden is that society is deprived of certain goods and services because of the risk in liability lawsuit. For example, companies manufacturing childhood vaccines close due in part of liability suits. Only a small number of firms manufacture vaccines, and those who only approved by the government. The final burden risk is worry and fear. These illustrate the mental unrest and fear caused by risk. Numerous examples can show worry and fear. A student who took a test and worries if she happened to leave an item blank, or worse, she'll get failed. Or a parent who fears if her teenage boy doing bad things in school.
Hello there! Let's proceed to our last topic for this chapter, techniques for managing risk. Techniques for managing risk can be classified broadly as either risk control or risk financing. Risk control refers to techniques that reduce the frequency or severity of losses. Major risk control techniques include the following: avoidance, loss prevention, and loss reduction. Avoidance is one technique for managing risk. For example, you can avoid the risk of being mugged in a high crime area by staying out of the vicinity. Another is you can avoid the risk of divorce by not marrying. Aside from avoidance, the other major risk control technique is loss prevention. Loss prevention aims at reducing the probability of loss so that the frequency of losses is reduced. For example, the number of heart attacks can be reduced if individuals control their weight, stop smoking, and eat healthy diets. And the last risk control technique is loss reduction. Just like the other two techniques, loss reduction also reduces the frequency of losses. It reduces the severity of loss after it occurs. For example, buildings with firewalls. Firewalls does not alter the chance of a loss or fire, but when one does occur, it is expected to be less severe, as it prevents the fire from spreading. Aside from risk control, the other technique for managing risk is risk financing. Risk financing refers to techniques that provide for the payment of losses after they occur. Risk financing focuses on methods for paying for losses, which is necessary because not all losses can be prevented. Risk financing is accomplished by retaining risk, and for some risk, some or most of the cost of potential losses is transferred to third parties, usually insurance companies. Major risk financing techniques include the following: retention, non-insurance transfers, and insurance. Retention means that an individual or business firm retains part of all the losses that can result from a given risk. Risk retention can be active or passive. Active risk retention means that an individual is consciously aware of the risk and deliberately plans to retain all or part of it. An insurance deductible is a common example of risk retention to save money. Since a deductible is a limited risk that can save money on insurance premiums for larger risks. Businesses actively retain many risks, what is commonly called self-insurance, because of the cost or unavailability of commercial insurance. Passive risk retention is retaining risk because the risk is unknown or because the risk taker either does not know the risk or consider it lesser risk than it actually is. For instance, smoking cigarettes can be considered a form of passive risk retention, since many people smoke without knowing the many risks of disease, and even if they know some, they don't think it will happen to them. Non-insurance transfers. Here, the risk is transferred to a party other than an insurance company. The three major forms of non-insurance risk transfers is by contract, hedging price risk, and incorporation of a business firm. Transfers of risk by contract. A common way to transfer risk by contract is by purchasing the warranty extension that may retailers sell for the items that they sell. The warranty itself transfers the risk of manufacturing defects from the buyer to the manufacturer. Hedging price risk. Hedging is a technique for transferring the risk of unfavorable price fluctuations to a speculator by purchasing and selling future contracts on an organized exchange. Two of these are the New York Stock Exchange and the Chicago Board of Trade. Incorporating. Another technique for transferring of risk, especially on business firms. Investors can reduce their liability risk in a business by forming a corporation, an S corporation, or a limited liability company. This prevents the extension of the company's liabilities to its investors. Lastly, the major risk financing technique is insurance. Insurance is another major method that most people, businesses, and other organizations can use to transfer pure risk by paying a premium to an insurance company in exchange for a payment of a possible large loss.